Flying high above the metropolis, it's the Roth Guy with holistic wealth advisor Jude Wilson.
It's time once again to talk with the Roth Guy here, Jude Wilson, and myself as we talk investing, finance, and retirement. And Jude, this week we're going to talk about something you've been wanting to do for a while here. We're going to talk about the Peter Thiel story. Am I saying that right? Peter Thiel?
Yep, that's his name.
Okay. Co-founder of PayPal, right? So early investor in Facebook, tech billionaire. And what's the angle here about sharing the story? Because I'm sure this is out there in multiple places on YouTube and whatnot. What's your thoughts about, kind of why you're sharing this and how we want to bring it to the clients here?
Yeah, absolutely. It's a concept that I've called the rocket Roth.
Okay.
How to explode your Roth and really put fire behind it so that it has the greatest potential value for growth.
Okay. And that's because that's basically something that he did, correct?
Exactly. If you research Peter Thiel, and no one knows for certain, but it's estimated that his Roth is worth over $5 billion.
Wow. Holy moly.
Exactly. And can you imagine all that money coming out tax-free?
Yeah, right. Wow, that's crazy. All right, so a little backstory. So in the 90s, he bought PayPal shares for pennies, and he put them into the Roth, right? So interesting concept there. Now, and we're not talking about that from a business angle, but we're just kind of sharing the backstory a little bit. And so I guess his thought process, right, was that you wanted to capitalize on the power of this particular financial vehicle. Again, the fact that you can grow the money and tax free.
Exactly, because when most potential clients come into our office and we analyze, their financial affairs, a lot of people now have a Roth. But one of the biggest mistakes that I see is the average client has a portfolio, whether it's mutual funds or individual securities. Right. Their portfolio is diversified between stocks and bonds. And it's usually some type of percentage between 60-40, let's say.
Right.
That's kind of the
standard. Yeah.
Yeah, that's kind of the standard. And everybody has heard of that saying, don't put all your eggs in one basket or diversify your investment.
Sure. We've said it a bunch of times, right?
Yep. But the next level is not only diversification, but asset location. Where should you put your assets for the greatest potential growth and the greatest potential tax efficiency? And my argument and the beginning of the Rocket Roth conversation that we've been having with clients is if you take $100,000, let's say, and you convert it from your IRA and you put it into your Roth, let's just for argument's sake say you put $100,000 into that Roth and you earn 2%. Well, it will take approximately 36 years for that $100,000 to double. Now,
wow. Okay. Yeah. I don't have that much time left anymore.
Exactly. But you'll see where I'm going with this.
Okay. All right.
So at 2%, that's probably a pretty conservative investment. That's probably
very, very conservative. Yeah.
Yeah. It's probably some T-bills, money markets, something like that.
Okay.
But what if you were to take that same $100,000 and be slightly more aggressive? Most people would say that the stock market averages somewhere around 8-9% over time. But let's
historically,
yeah. But let's be even more conservative than that. Let's say 6%. If you took that same $100,000 and invested in a stock that over time averaged 6%, well, it will double in 12 years.
A little better timeline.
Yeah. So let me ask you a question. If you had an opportunity to grow your Roth, would you take the most conservative investment and put it in your Roth? Or would you take the most aggressive investment and put it in your Roth?
That's a good question. I mean, I think we can hear that and we can hear the answer. Sounds like we should be being a bit more aggressive with it. What do people tend to do? Like when you are analyzing people's portfolios when they come in, do we tend to lean more towards the conservative side of things or are more people aggressive out there?
People tend to have their investment strategy go across all their different accounts, whether it's an IRA, a Roth, or just a traditional investment account. They
So the same
tend
strategy across the different buckets. Okay.
the same strategy across all different accounts.
Okay.
And what we've been helping clients with is the same amount of money, but reallocating it for the highest potential benefit. So let's say you have $1 million in total between your IRA, your Roth, and your traditional investment account.
Mm-hmm.
The concept of the Rocket Roth is to say, you don't necessarily need to change that 60-40 percentage, but what you may want to do is that 60% that is allocated to stock,
Right.
have that be the greatest portion of your Roth, because that has the greatest potential for growth.
So take your aggressive side where you're still trying to outpace inflation and you're still trying to grow the wealth, and get a little maybe more aggressive in the Roth account, and then some of your safer or protected monies, right? Some of your sooner monies, then you want to get more conservative or safer with that. Is that what I'm hearing?
Exactly what you're hearing, because the way Peter Thiel was able to get what some say is almost $5 billion was he took his PayPal stock before it had grown, and nobody knew at the time that PayPal was going to be the tremendous success that it was. But can you imagine if you bought PayPal before it exploded, or if you bought Tesla or Apple before everybody knew about it?
Sure.
And that was...
Well, it's what we all want, right? I mean,
exactly.
We all want to do that. Yeah,
exactly. But if that was all in your Roth, that would not only accelerate the growth, but all that money coming out tax-free. And that's what we're trying to get to with the Rocket Roth concept.
So what are some of the common mistakes that people do? So like, if that's the case, if we're talking about being the aggressive versus not aggressive, when you're kind of analyzing people's stuff, what do we have in Roth? Do we have like our, I don't know, bonds or some cash values or like, what are you seeing there?
Exactly. A good portfolio, most financial advisors are going to tell you, you've got to have some stocks or equities, you've got to have some fixed income or bonds, and you may have some cash. That's the general construction of a good portfolio. The argument that I'm making is you can still have a great portfolio, but having that same diversification, that 60-40 in the Roth, doesn't give you the opportunity for the most amount of tax efficient growth. So it's all about asset location in addition to diversification.
Now, as always, when we're talking about this stuff, we don't want people to just run out and wholesale change things without seeing how it affects their strategy. But if you're kind of appealing to people's, thoughts, a sense of, hey, what are we doing? Do I want to be more aggressive or whatever? What would be some suggestions to talk with your advisor on to kind of go and look through some of this stuff? Any thoughts there?
Yeah, well, as you know, and we've talked about this on prior episodes, at the firm, we like to have visuals to help people understand things.
Sure.
So we have the tax funnels, the pre-tax, the post-tax, and the tax advantage funnel. What I would recommend to people is, if you're working with a good financial advisor who understands this type of stuff, or even your accountant, is to look at how you're allocated among all those three funnels and see, does it make sense to reallocate some of your monies, particularly in the tax advantage funnel, take the more aggressive part of your total asset allocation and put it into the Roth, or restructure the Roth so that has the most aggressive piece, and the less aggressive piece to be either in your IRA or your regular investment account, which we call non-qualified account. Right. So that should be the conversation you have with your advisor. What's the tax consequence? Because you may have to, of course, move some money around to get to the right percentages for you. But to your point, this shouldn't be done willy-nilly. Don't listen to this episode and say, I'm just moving everything to equities in my Roth.
Yeah, because the strategy is sound. I mean, like, why would you? I mean, if you think about it that way, like, kind of putting yourself in that position and saying, considering the monies that I'm trying to be more aggressive with, why wouldn't I want those to be tax free, right? So why wouldn't I want them to be more in that Roth? I mean, it makes total sense. It seems so very obviously low hanging fruit, yet we tend to not maybe capitalize on that. But again, you still want to make sure that everything is done, calculated, not just this sounds like a good idea and it probably is a good idea, so let me just jump into it. Same thing with Roth conversions, right? Just because you want to convert $1 million from your traditional account to your Roth because you want to get all tax efficient, well, cool, but don't do it willy-nilly in case you jack yourself up from a tax standpoint.
Exactly. And there is some sense of urgency behind this, because reallocating, probably one of the best times to reallocate is as you're thinking of Roth conversions.
Right.
As you're moving money from an IRA or from a 401k into the Roth. Well, to cross that bridge, there's one big thing you got to do. You got to pay taxes on that money. And
where are you paying it from, right? So people will often say, I want to convert and I want to use the money from that same account. But a lot of advisors will say, no, we don't want to do that. You want to have the actual dry powder, the cash, right? Or whatever to kind of pay that. Okay.
Exactly. And this is the strategy behind it, and why I strongly suggest people look toward a financial advisor or CPA that really understands this, because as you make that conversion, that would be one of the best times to see how your percentages line up to equity versus fixed income. The other sense of urgency behind this, and we don't talk politics on the show. We talk about how the government affects our planning.
Yeah,
exactly.
And we're seeing a lot of stuff right now. So
for certain,
right.
The Tax Cut and Jobs Act is set to expire at the end of this year. Now, there's a lot of talk that because Trump has won the election, that the Republicans will seek to extend that.
Right.
But it's set to, as we talk today, it's set to expire in December of 2026.
Yeah, and we're in mid 2025, Jude. It expires this year.
I'm sorry.
No, you're fine. Yeah, it expires this year. And we're in mid-March right now at the time we're taping this. So, I mean, there's obviously stuff happening fast and furious. So we'll see, when they get to the TCJA. I mean, they'll have to get to it soon if they're going to extend it. That's for sure.
Absolutely. So the sense of urgency behind this is that there's things that we believe will happen and there's things that we know would happen. Right now, we know it's set to expire. And so before you implement this type of strategy, it's important to know what the benefit might be to you and what the cost may be. That's why we've created the tax calculator, and people can go to the tax calculator and find out what their potential exposure could be.
Yeah, and we'll have the links in the show notes as always, folks, but you just go to thetaxbomb.com. Again, thetaxbomb.com to go check that out, but we'll have links in the show below. So just, I guess, kind of finish this off with asking yourself this question. What would you place in the Rocket Roth if you had the chance to do that again, right? And so it would be, pretty interesting to kind of get people's thoughts on some of that. And would you want to, do you want to be more aggressive with this particular piece of your account? Now, I know it's interesting that we're talking about that at the time of recording this because the market's been a little choppy this month.
Just a little bit.
But I mean, it entered into a correction technically at the time we're taping this, Jude. But a correction is 10%, and corrections are normal. And we do need to be honest and say, look, a lot of stuff's been heavily overweighted. The PE ratios out there have been pretty high for a lot of companies. So, the fact that we're seeing it, yes, it could be some of the tariff stuff. Yes, it could be some of the different things happening with policies. All that stuff certainly factors into it. But, at the same time, you got to have a grain of salt with this, right? Because, and you also got to think about where are you at on your timeline, because a correction's not necessarily bad if you get a chance to buy on the dip, right? All that kind of stuff. But again, is it part of your strategy? Don't just do stuff willy-nilly.
Absolutely. Everybody has heard, hey, in investing, you want to buy low and sell high.
We never do, but
exactly. But we run for the hills when we see volatility like this. Yeah. And this could not be the more appropriate time to not only look at your allocation. Again, are you 60-40? Are you 80-20? Whatever that may be.
Right.
But then also strategically plan on not only investment diversification, but asset location. Where should your asset be placed among the different accounts that you have?
All right. Well, we'll wrap it up with that. So we really didn't get too much into Peter's story because it's out there all over the place. If you want to learn more about that, guys, definitely very interesting. But it was really more important to kind of just talk about the concept of what he used to build this incredible wealth. And so maybe that's something, worthwhile for you to think about on a more, normal scale, I suppose. But make sure that you're having those conversations with your financial professional. Again, we'll have links in the show descriptions below so that if you need to reach out to Jude and get yourself on some time on the calendar, you can do so at the websites. We'll have his main website. We'll have the taxbomb.com website. All that stuff's listed in the descriptions below. Don't forget to subscribe to us on Apple or Spotify or YouTube for whatever podcasting or app you like using for consuming this kind of content. We certainly appreciate the support of the channel. Just click on that thumbs up and that notification bell so you catch new episodes when they come out of the Roth Guy. Jude, thanks for hanging out, buddy, and breaking it down as always.
Let's rocket your Roth.
There you go. Let's rocket that Roth, and we'll talk to you next time here on the Roth Guy.
Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. Centrus Financial Strategies and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through Centrus Financial Strategies are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website, www.advisorinfo.sec.gov. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.